Hi, hello, welcome friends. In this video, we are going to discuss financial instruments unit 3. So, we have completed unit 1 and unit 2. Now, we are going to unit 3. What is there in unit 3? So, financial instruments, equity, and financial liabilities. So, the financial liability means what? Financial asset, equity means what? So, we have some definitions. So, in definitions, we need to satisfy the both conditions. In case of it, in if we satisfy the both conditions A and B, it will become equity. If we are satisfied either A or B, then it will become the financial liability. Now, condition 1 and condition 2. So, what is the condition 1? A instrument that is contractual obligation. So, if entity has any contractual obligation, then it will become the liability. If the company does not have any contractual obligation, then it will become the equity. Now, for the purpose of this contractual obligation means they may be to deliver cash or other financial assets or to another entity, so they are liable to pay cash or any other financial assets, then it will become contractual obligation. Or to exchange one financial assets or financial liability with another entity under the condition that they are potentially unfavorable to the entity. So they have some unfavorable conditions to the entity, they are likely to exchange financial assets or financial liability. It is also one contractual obligation. So when it has contractual obligation, it may become financial liability. If contractual obligation is not there, it may become the equity. And another one, second condition is that any instrument that will arise, that will or will be settled in the entity's own equity instruments. Here also we will see in same only an instrument that will or may be settled in the entity's own equity financial equity instruments. And here two differences will be there. First one, if it is derivative, means that instruments will be derivative or non-derivative, we will bifurcate. If it is derivative, then the settlement will be there only through by the stock, by the exchange of fixed amount of cash or another financial assets of fixed number of entities own equity instruments, then it will be equity own related to equity instruments. Or if it is non-derivative, then the includes no contractual obligation for the issuer. So the issuer will does not have any contractual obligation to deliver variable number of entities own equity instruments. Then when both A and B conditions were satisfied, then it will become the equity. When both A or B was satisfied, it will become the liability. So here non-derivative means for which the entity is or may be obligated to deliver variable number of entities own equity instruments. So if it is fixed number of equity shares, it will become the equity portion. Why fixed will be become equity means here we will see. So is there equity? If equity is, for example, they already told that equity will be 1 lakh shares. So 1 lakh shares will be there for equity. So if they decide amount, so amount was decided 10 lakh rupees. So it will become for based on amount they visited, it will become the liability, financial liability. Based on equity, it was became the financial equity. Why? If it is 1 lakh shares means they may be change in MPS will be considered. So MPS may change 100 or 50 or 80, whatever the amount. So then it will be changing. So value will be changing means there will be how a risk. So when there will be a how risk, it will become the equity portion. That is the case. So if you see in fixed number of equity shares, it will become the equity portion. So now here the important will be there must be there two differences mirror image of each other. So here we will discuss about contact and contractual. So here contact means what, contractual means what. So first of all here one agreement. So there is one agreement between one party and another party. So one party has agreement and another party has agreement, so they have clearly mentioned the economic consequences that parties have little. So if any they have any discrepancies to avoid, or as usually because the agreement is enforceable by law, so this agreement will be enforceable by law. And this contract or financial instrument, this contract may be in any form or any format, so there is not, some cases it need not be in writing also. Now liabilities may are not contractual, so sometimes liabilities are not contractual, means some in statutory provision, some income tax related liabilities, so it is not mandatory to enter into a contract liability, but they will arise the liability, then is not financial liability. So accounting for income tax deal with India is 12. So India yes we will discuss income tax related constructive obligations as defined in Indian 37. Constructive obligation means India 37 will be discussed. So in 37 India is 37 contingent provisions, contingent liabilities and contingent assets, so does not arise from contract and not financial liability. Now items such as deferred revenue and most warrant obligations are not financial liability. So we are seeing that some liabilities are not contract as based, that is we have seen the example of income tax or GST payments, or some cases some accounting for income taxes it will deal 32, and some provisions, so contractual obligations will be there some cases. So constructive obligation means does not arise from contract and not financial liability. Next items such as deferred revenue and most warrant obligations are not financial liabilities because the outflow of economic benefit associated with them is the delivery of goods and services rather than the contractual obligation to pay cash or another financial assets. It should also be remembered that the requirement to satisfy the contractual obligation may be absolute or it may be contingent on the occurrence of future events. So for example, financial guarantee is contractual obligation of the guarantor to pay the lender if the borrower default. Now we need to analyze the definitions points. So we have evaluation of components. So components means it is not always the entire instruments, it may either financial liability or it may become the equity, and here issuance determination component will be substance, so which is substance is the main important. Next contract is supreme where substance does not override the or contravene the contractual terms. Next contracts cannot override the law, the entity must consider all terms and conditions whatever they entered in the financial instrument in determining its classification as financial liability or equity. So those terms and conditions or laws regulations the entity governing charter in effect of the date of classification but not exceed future economic amendments those laws and regulations. Now we will summarize the definition of financial liability and financial liability. First is their contractual obligations. So when it is their contractual obligation, if it does not have any contractual obligation, not financial instrument, so account for under relevant standard. So we must have one contractual obligation. Then here the obligation may be payable in cash or another financial assets. So payable in cash or another financial assets, so yes it will become the financial liability. No, we do not have any liability to pay in cash or for other financial assets. Then obligation to exchange, here exchange, you are using exchange financial assets or liabilities under potentially unfavorable conditions. So if you have unfavorable condition, because that unfavorable condition you are exchanging the assets, then it will become the financial liability. So you have some potential unfavorable condition, it will become financial liability. No, and we have obligation to issue own equity shares and either the consideration received or receivable or number of equity instruments is variable. So if it is variable it will become financial liability. If the equity instrument is fixed then it will become the equity instruments. So we will see that. So firstly we have contractual obligation. That contractual obligation may deliver cash or other financial asset, then it will become financial liability. No, we are exchanging some financial assets or financial liability because some potential unfavorable conditions. So because of unfavorable conditions it will become financial liability. No, not for unfavorable conditions. You are in regular term, okay, you are in regular term, okay, you are issuing obligation to issue own equity shares and you are issuing at variable equity instrument for fixed amount, then it will become the financial liability. You are issuing fixed number of equity shares, then it will become the equity instruments. Potentially unfavorable conditions means PQR Limited issue one call option. So call option means company will get the right and to buy, option to buy to ABC Limited to subscribe PQR Limited. So PQR Limited issue the call option to ABC Limited to PQR Limited equity shares at price of 100 per share. The call option is to be settled on net basis. So how they are settling? Net basis. So they will settle on net basis, that is without physical delivery of shares. If the balance sheet date market value of equity shares was 110 rupees per share, PQR Limited will be obligated to pay 10 rupees to settle the option. So such has a condition potentially unfavorable to PQR Limited. So here PQR Limited has issued the call option and PQR Limited has unfavorable because they issued the call option that subscriber was subscribed some PQR ABC Limited is subscribed, they are paid some, they in call option they are entered net basis, so without physical delivery. So on the balance sheet market value of equity shares was 110 rupees, PQR will be obligated to 10 rupees. So they entered for 100 rupees and they are received some premium now, so that they need to settle at 10 rupees and 10 represent financial liability because of unfavorable condition, because they entered in call option, so that it became the liability unfavorable conditions. Next, obligation to deliver cash. Here some critical features differentiating the financial liability from an equity instrument in the existence of contractual obligation of the issuer either deliver cash or another financial assets to holder or exchange financial assets or financial liabilities with the holder under condition that potentially unfavorable to the issuer. Now here some limitations, exceptions will be there. If there is a puttable instrument or obligation arising on liquidation, or puttable instruments and obligations are arising on liquidation. So now we will see there he is a financial instrument that does not explicitly establish a contractual obligation to deliver cash or another financial assets, may establish an obligation indirectly through its terms and conditions. Now here redeemable preferences. So you need to see redeemable preferences with mandatory dividend. Is there mandatory for dividends? So first of all, what is there here? One company is there, a company is there, and his holder will be the holder, and he have some preference shares and for 10 years preference shares, and 10 years they are cumulated 15% dividend rate of dividend commensurate with the credit risk profile of the issuer. So examine the nature of financial instruments that preference shares, whether it will be become the equity or financial liability. So they are not paid any dividend up to 10 years, they are entitled 15% dividend cumulatively. Now they have liability to pay cash, and if they converted they will become the owner. So redeemable means they will redemption means cash, so it will become the financial liability. So these instruments provide mandatory fixed dividend payment and redemption by the issuer for fixed amount at a future date. So since they have contractual obligation to deliver cash, so redemption will be there, means it will be deliver cash for both dividend and repayment of principal to the principal shareholders that cannot be avoided. The instrument is financial liability in its entirety. Next question number second one. X company limited issuer the issue some debentures to Y company limited, that is holder. Those debentures are redeemable at the end of 10 years from the date of issue. So here they have X company is there and Y company is there, okay, X Y both person is there. Here X issued debentures, so the debentures are redeemable at the end of 10 years from the date of issue. So interest rate will be 15% is payable at the discretion of the issuer. Rate of interest is commensurate with the credit risk of the issuer. So they are liable to pay that interest. Now here two components will be recognized. One will be, just a second here, I think it is better, it is also better, it is also better, I will get the more. Okay. Two components is there. One component will be mandatory redemption by the issuer for fixed amount of fixed future date. So here cash is involved and interest is payable at the discretion of the issuer. Now first component is contractual obligation to deliver cash, that for repayment of principal with or without premium as per terms, so to the debenture holder, that cannot be avoided. This component is financial liability. First, and second one, the second component of interest payable is discretion of the issuer. Now here nth will be classified as equity, so it will be equity. So when the one as debt plus equity, it will be known as compounded financial instrument. We will discuss later in detail. Next, here another one, question number third one. One company is there, P company is there, and Q company is there, taken from loan. So it has taken loan. The loan is perpetual and entitled to the holder to fixed interest 8%. So how much interest? 8% interest. So the directly it is obligation will be cash, so it will become the financial liability. So here two components will be mandatory interest by the issuer for fixed amount at a fixed future date and perpetual nature of principal amount. So first component is contractual obligation to deliver cash to the lender cannot be avoided. The component of instruments is financial liability. Next, the lack of access to foreign currency or need to be obtained approval from the payment from regulatory authority will lead to contractual obligation. So here we do not have access to foreign currency, we need to get the approval payment from regulatory authority. So does not negate the entity's contractual obligation or holder's contractual right under the instruments. Now so here does not negotiate the entity contractual obligation or holder's contractual right under the instruments. Next, question number 51. In question number 51, one company is there. What is the company? D Limited is there and issued G Limited preference shares. The holder has an option to convert these preference shares to equity of the issuer anytime up to the period of 10 years. So is at the option of holder. Preference shares, equity instruments anytime. If the option is not exercised by the holder, here this person is issuer, this person is the holder. Okay, at the option of issuer, and if the option is not exercised by the holder, the preference shares are redeemed at the end of 10 years. So he has option. So this person has option. He may go for equity. If he has not go for equity, it will payable at cash. So here two components will be there. One is contractual obligation that conditional on holder exercising its right to redeem. So he may that person have a right and conversion option with the holder. Now the first component is financial liability. This component it has liable to pay, it is financial liability, and because the entity does not have unconditional right to avoiding deliver cashes, if he does not exercise, he will need to pay the cash. In section component financial instrument, we will also analyze the other component, the conversion option. So here they are preference and equity option, so it will become the component financial instrument. We will discuss later in next chapter. Next, another one will be question number 61. Here LM and company is there and issues PQR some preference shares. So preference shares are redeemable at the end of 5th year. So they provided 5 years term and from the date of issue. The instruments also provide settlement alternative star to the issuer whereby it can transfer a particular commercial building to the holder. So they will whose value is estimated to be significantly higher than cash settlement. So they are giving option, you can take cash or you can take the billing, that is SAR related. So Now such preference shares are financial liability because the entity can avoid transfer of cash or another financial asset only by settling the non-financial obligation. So it is financial liability. Next, putable instruments and obligation arising on liquidation or exception to reclassification of financial liability for instruments settled in cash or another finance. So here we need to treat the two concepts. So one is mutual funds, that is some unit trust is there, the redemption amount is equal to net assets of entity, or some limited life in entities is there, that SPV is there for execution of infrastructures projects. First we look the one definition relevant for discussion. So putable instruments means what? Putable instruments means here right to put the instrument back to the issuer for cash or another financial assets, or is automatically put back to the issuer on the occurrence of an uncertain future event or death or retirement of the instrument holder. Here we discuss that financial instrument means we have obligation. So obligation may be delivery in cash or another financial assets, that is financial instrument. If it may be classified as financial liability. When financial liability will be classified when it has putable instruments or and financial instrument that create obligation only on liquidation of the entity. Liquidation may be certain to occur and outside issuer control or uncertain to occur at the option of the holder. So at the option of the holder it will become the financial liability. However, India AS 32 contains some exceptions also, whereby such instruments also are classified as equity and otherwise meet the all conditions of financial liability. These exceptions apply if all the following conditions are fulfilled by the instruments. So if here the holder pro rata, so we will go with the pro rata shares of the entity's net asset in the event of the entity's liquidations. So in other words, instruments could not entitle its holder to higher or lower to higher. So here we need to see the one example, we will get the some clarity. They provided ABC company there and they have two shares, class of shares A and B. So for A they have putable shares and B they have two classes of putable shares. So here on liquidation B shareholders will are entitled to pro rata shares. So on pro rata shares they will get maximum 10 lakh rupees. So amount will be 10 lakh rupees and there is no limit of to the right of class A shareholder to share the residual. So they will get the residual assets. So here with the more risk, so this person only have more risk. So the cap is of 10 lakhs for B, that class B share does not have entitled to pro rata shares of the residual assets of the entities on liquidation. So if entity A is on liquidation, they will not get more than that 10 lakh rupees. They cannot therefore classified as equity. So they do not have the liability. Only to the extent of this they have liability, it will become financial liability. So they will get more amount there, it will become the equity amount. Now in this it is the class of instrument subordinate to all the other classes of instrument that is in its present form. It has no priority over other claims to the entity's assets and liquidation. So next, entity will need to assume liquidation on the date of classification. Investment manager share in a mutual fund. So here one mutual fund is there, mutual fund X is there, and as the investment manager Y is there. So and at the inception of the fund, Y had invested nominal or token amount in unit X. So Y is invested in this fund. So such units rank last for the repayment of the event liquidations. Accordingly, they constitute more subordinate assets of financial. Examine the nature of financial instruments. Now here units held by Y holder are classified as equity as they are most subordinate of instruments and will be entitled to residual. So they will get the residual interest now. When residual interest option is there, it will become the equity. So it will become the equity. However, the units held by other unit holder are classified as financial liability. As they are not the most subordinate class of instruments, they are entitled pro rata shares of net assets of liquidation, and their claim has priority over claim of Y. It may be noted that most subordinate class of instruments may consist of two or more legally separate type of instruments. Next, third one, in case of puttable instrument or financial instruments in the more subordinate class have identical features. So for example, they must all be puttable, and formulas or other methods used to calculate repurchase redemption price of same for all instruments. So for example, we have illustration 9. Here T limited is there, and it issued some puttable ordinary shares and puttable A ordinary shares, where the holders of the ordinary shares are entitled one vote per share, whereas holders of A ordinary shares are not entitled to any voting rights. So they are issued some ordinary shares to A, they will not get any voting rights. So they will not get any voting rights here. And the holder of two classes of shares are equally entitled to receive shares in net assets upon liquidation. Now neither two class assets, so neither two class of puttable shares can be classified as equity. So a person does not have equity, and other two persons, they will get in a pro rata basis, that is net assets will be equally, means pro rata means 50:50 ratio they will get. So when they are getting some limited amount from the company, it will not become the equity, as they do not have identical feature due to difference in the voting rights. It is not possible for T Motors Limited to achieve equity classification in the ordinary shares by designating them as being more subordinate than the A ordinary shares, as this does not reflect the fact that two class of shares equally entitled to shares in equity residual assets on the liquidation. So in the context above, in the case of instrument that impose on entity an obligation to deliver pro rata shares of net assets only on liquidation. So all financial instruments in most subordinate classes have identical contractual obligations. So when in case of puttable instruments, apart from contractual obligation for issuer, they may repurchase or they may redeem the instrument for cash or another financial assets. So there is no other contractual obligation to deliver cash or another financial assets, or they may be settled variable number of equity own equity instruments. So for example, if we see 10th question, yes company is there and they have issued some puttable shares to T Limited. Besides that puttable options, they also, which is considered with other class of ordinary shares, T Limited also entitled to convert the class ordinary shares held by it equity. So they have option to convert. So they have option to convert into equity instruments of S Limited, whose number will vary as per market value of ES Limited. So examine the financial instruments. So now it will become the equity instruments. So the share cannot qualify for equity classification in their entirety, as in addition to put option, there is also contractual obligation to settlement in variable number of they are giving in variable number of shares. They also entitled to convert the shares ordinary shares held by it into equity instruments of S Limited, whose number will vary as per market value of the S Limited. Now examine. So they are fixed the value, fixed amount, shares may vary, but when they fixed shares, amount will vary. So here amount was fixed as per that market value. For example, 1 lakh shares is there, as on date market value is 5 rupees. 1 lakh into 5, it will become 5 lakhs. So amount of 5 lakhs, how many shares they will get, they will recognize. So then it will not become the equity instruments. Next, total expected cash flows attributable to instruments. So life of instrument substantially on the profit and loss or change in net assets, change in fair value, unrecognized assets. Now we will see 11th question. Here one fee is there, P Limited is there, and they have puttable shares given to Q Limited. Q Limited also entered into an asset management contract with P Limited, whereby Q Limited is entitled 50% of profit. So here P Limited will entitle 50% of profits. P Limited, normally commercial terms for similar contracts, will entitle the service provider to only 4 to 6% of net profits. examine whether the financial instrument will be classified as equity. So here the puttable optional shares cannot qualify as equity classification because in addition to the put option there is another contract between the issuer and holder of put. Here issuer means P company and holder will be Q Limited, whose cash flows are based on substantially on profit or loss of issuer, whose contractual terms is not similar to contract between non-instrument holder and issuer, and it has effect of substantially restricting return on puttable ordinary shares. So in terms of asset management contract were assessed to be similar to terms of contract between a non-instrument holder and issuer, it would not have precluded equity classification of puttable shares provided other conditions are met. So for puttable instrument we need to see the condition 1 to 6, and for instrument that create an obligation only on liquidation we need to see the condition 1 to 3 and 6. Now reclassification on the date of classification and the date of reclassification. Date of classification: financial instrument as an equity instrument in accordance with exceptions mentioned above. So whatever the exceptions will be there we will. And date of reclassification: financial asset for the date when the instrument ceases to have all features meet all conditions are set above. Now we will see account classification, reclassification. Firstly we will see financial liability. It will be equity. It will be equity when carry value at date of reclassification. Recognition is not applicable. When equity, it is financial liability. So from liability to equity there is no, and from equity to liability fair value at the date of reclassification we need to recognition in equity. Now question number 12 one, we will see the question number 12, we will get some clarity. Now A Limited is there. A Limited issued some CCPS compulsory convertible preference shares to some we will take some person big company limited for 10 lakhs rupees each year. Now 100 rupees each for value. Here 100 rupees means 10 rupees will be the face value and 90 rupees will be the premium price. Total value it will become 10 lakhs. Now there was convertible into equity shares at the end of the 10 years. So these preference shares will convert into equity to be issued shall be determined based on the fair value of equity shares. So fair value of equity shares to be determined at the time of conversion. Evaluate if this is financial liability or equity. If the conversion rate was fixed at the time of issue of such preference shares. So as per Ind AS 2, here non-derivative contract. So here we have non-derivative contract which will be settled against issue of variable number of own equity shares meet the definition of financial liability. So here the non-derivative contract which is settled against variable number of own equity shares. So when we are settling variable number of equity shares it will be the financial liability. In this case A Limited has issued some CCPS which are convertible into variable number of shares. So hence it is akin to use of own equity shares as currency for settlement of the liability of CCPS issued. Accordingly it meets the definition of financial liability. Now here measurement. For initial measurement this shall be measured at fair value. So all financial instrument for initial measurement we will go with the fair value only on the date of transaction. So since A Limited shall give shares worth 10 lakh at the end of the 10th year which is equal to amount of borrowed on the day 1, the liability is recognized at fair value determined discounting future settlement borrowed amount. So for different arising on day 1 between the amount borrowed and that is recognized as liability using the level 3 inputs. So it is deferred and recognized on a systematic basis over the period of liability. Next, subsequent measurement. Here such liability shall be carried FETPL. So as per Ind AS 109 for subsequent measurement they may go for FETPL or FETOCI or FETPL OCI and amortized cost. As per India AS 109, non-derivative contract that involves issue of fixed number of equity shares shall be classified as equity. So non-derivative contracts, when we have fixed number of equity shares, it will be classified as equity. In this case, if the conversion of CCPS was into fixed number of equity shares at the end of 10th year, then it meets the definition equity and hence classified as equity cost, and no further adjustment made to it carrying value after initial recognition. Obligation to purchase own equity instruments. So with the exception of some cases, this meet the fixed test. So contract that contains an obligation for entity purchase its own equity instruments of for cash or another financial asset give financial liability. Present value of redemption we will consider. If it meet the fixed test and would equity is in the absence of this rule. So contingent settlement provision, we will see that fixed test how we will calculate. So firstly, contingent settlement provision. Here one financial instrument need to deliver some cash or financial assets. So to settle or some other way, they may require to classify as financial liability, but only in the event of occurrence or non-occurrence of some certain future event. The event may within the control of issuer or the holder or beyond control of both. So this type of contractual arrangements refer to as contingent settlement provisions. Here we will see the chart, we will get some clarity. So we have contingent event within the control of issuer. So if we have yes, then it will be classified as equity. So you have contingent event within the control of the issuer. So issuer control, it will become equity classification. If issuer does not have the event control, maybe it have older option, then asset whether the part of the contingent settlement provision that indicate liability classification is genuine. If it is indicating as a liability, then it is not, it will become the liability. If it is not indicating as a liability, then we will go for the equity classifications. Next, can the issuer be required to settle that obligation in cash or other financial assets only in the event of liquidation? So only in the event of liquidation it is become equity classifications, or they do not have that case, then does the instrument have all the features and meet all conditions relating to exceptions for puttable instruments and obligation arising from liquidation. So then it will become the financial liability classifications. Next, return put options over non-controlling NCI, non-controlling interest. Here the consolidation financial statements, an entity present NCI, that is the interest of other parties in the equity and income of its subsidiaries. So in accordance with India AS 1 and India AS 110. So we will see India AS 1 means first time adoption of India AS. India AS 110 means it is the consolidated financial statements. Now settlement of entities own equity instruments. Here entity financial instruments is classified as liquidity, not just where there is the obligation to deliver cash or another financial assets. So sometimes it also classified even when entity obligation to settle instrument through delivery of its own equity instruments. For we have two alternatives. So one, we will see that convertible option. So here one company is there, company C Cap Limited is there, and it has issued convertible debentures to RXKP and for subscription amount for 200 crores. So these debentures are convertible after 5 years into equity shares of CBA Limited using the predetermined formula. So what is the formula? 100 crores into 1 plus 10% to the power of 5 divided by fair value on the date of conversion. So such a contract is financial liability. What it will become? It will become the financial liability of the entity. So even though the entity can settle it by delivering its own equity instruments, so it is contract is a financial liability. Here the settlement will be delivering own equity instruments, but it is not equity instruments because the entity uses variable number of own equity instruments as mean to settle the contract. So they are using the variable number of equity instruments, then it will not become the equity portion, so it will become the liability only. And company D Limited is there and they have J Limited is there. Subscription amount will be 100 crores and the debenture convertible after 5 years into 15 crores equity shares of 10 rupees each. So these is financial instruments. So what is this? They have equity instruments, and because of change in fair value of equity shares arising from market related factor does not affect the amount of cash or financial asset to be received, the number of equity instrument to be received or delivered, then it will be financial liability only, because it will not affect in, even though they are issuing the equity shares, it will not affect the decision. So from above two situations we can conclude that a contract is not an equity instrument. So it is not an equity instrument because they are issuing the equity instrument, it will not become the equity instrument. That is the case because it may result in the receipt or delivery of the entity's own equity instrument if an entity has contractual right or obligation to receive or deliver number of its own shares or other equity instruments that way, so that fair value of entity's own equity instrument to be received delivered equity equals the amount of contractual right or obligation such as contract financial liability. Here what they are telling, simply issuing of equity, it will not become the equity instrument. So is the equity instrument in variable and amount already fixed, so amount is fixed, then it will become the liability only. And the second one, a contract that will be settled by entity, that is receiving entity, delivering fixed number of its own equity instrument in exchange for fixed amount of cash or cash. So amount is fixed, amount of cash or another fixed assets in an equity instrument. So amount already fixed, but that amount they are issuing some equity shares, then it is also financial liability. So for example, we will see the consideration, financial instrument is fixed and number of own equity shares issued will be, settlement will be variable. So we have financial instrument fixed and we are issuing for that, we are paying in variable equity instruments. The clarification will be fixed liability. So financial liability, because own equity shares are issuing, okay, we are taking, and instruments are being used as currency to settle the obligation for fixed amount. So a fixed amount liability is there, for that fixed amount liability settling we are issuing the own equity, it is acting as a currency, so it will not become the equity instrument. Next, fixed instrument and we are issuing the fixed securities, then it will become the equity, because the amount may vary, because the amount may be based on the fair value on that. So equity issuer does not have an obligation to pay cash, so and holder is not exposed to any variability. Next, variable, here fixed, variable instruments and fixed equity instruments. So financial liability through issuer does not have an obligation to pay cash, but holder is exposed to variability. Next, variable or it also variable, so then financial liability through issuer does not have an obligation to pay cash, but both parties are exposed to variability. Now in second case, fixed for fixed test, the fixed amount of cash or other financial assets for fixed number of own equity settlement. So when fixed to fixed case is there, then it will become the equity, other than it will become the financial liability. That is the case. And after that, return option for fixed or variable number of equity. So here one company is there, S company is there and 80 company is there. So he has purchased options, so fixed number of equity shares, so fixed number of equity shares, fixed exercise price, so price also fixed at time of during the period of 3 months. Holder paid initial premium 2 rupees, so for 48 they are paid 2 rupees, means 50 they are paid 2 rupees, means 48 is pending. Examine whether financial instrument will be classified as equity or not. No, because amount is fixed, so here for issuer 80 limited, this option is an equity instrument as it will be settled by exchange of fixed amount for cash for fixed number of its own equity instruments. So if that amount fixed amount of fixed number of its own equity, in other words, if the exercise price, so if they go with the fixed amount of cash for fixed number of shares, so they are fixed the number of shares, they are paying the cash, then it will become equity. If they are exercising the option, means they are fixed the amount also, then it will not become the equity, it will become the financial liability. Now for discussion on derivative instruments, we will go with the chapter 4. So summary, fixed to fixed test summary. What is their conversion feature fails, fixed for fixed, then conversion fails, we will see the next one. Conversion is not failed, means they have fixed to fixed, then it will be equity. Consideration is received, consideration received is credited to equity. Next, conversion feature is derivative, then yes, subsequently measured at fair value with fair value changes recognized in profit and loss. So conversion feature is derivative, then no, it does not have derivative, can subsequently measure at amortized cost. Next question number 16th one. Here written the one company is there, WC company is there, and they write some options on favor of GT Limited. So wherein the holder can purchase issuer's equity instrument at a price fluctuating in response to share price of the issuer. So they are given the assurance of fixed amount. So then fixed amount is there, it will become the financial liability. So it will become the financial liability. Next, swap arrangement. Swap means what? To exchange the series of cash flows. So in swap we have interest rate swap, currency swap, and total return swaps. So acquirer limited enters into an arrangement with shareholders of Target Limited, wherein acquirer limited will purchase shares of Target Limited in share swap arrangement against a variable amount of cash. So it is their variable amount of cash, that is market value of Target Limited equity shares. So company is entered in one arrangement, they are ready to purchase shares of companies, they have share swap. They have share swap, means when the swap is there, it will become the derivative liability. In derivative liability, and swap ratio is 1.1:5, that is 1 equity shares of acquirer limited for every 5 equity shares of target company. Examine whether the financial instrument will be classified as equity. No, here the such arrangement will not meet the condition of equity instrument, since the net contract will be settled by delivery of fixed number of acquirer limited own equity instrument against variable amount of cash. So that is market value of Target Limited equity shares. So such contract will likely to result of derivative liability, assets of both the parties. It will become the derivative liability. There is no amount cases. Now question number 18th one. Here one company is there, NXT Limited is there. Here the for VT they are provided convertible preference shares. So conversion ratios will be provided. Here they do not give the any amount. So then amount is not given, it will become the equity, because the amount we take in fair value. So when fair value means it may vary. So when fair value means there is risk. So when there is risk, it will become the equity. So conversion was happen 1:1, conversion was happen 1:5, and conversion was happen 2:3. So the convertible preference shares can be classified as equity instrument in the books of issuer VT Limited. The conversion ratio does not change corresponding to any underlying variables. It only varies in response to passage of time, which is certain event and hence fixed. Next, on January 2001, HT Limited subscribes to convertible preference shares of RT Limited. The preference shares are converted in the ratio of 1:1. So what is their conversion ratio? 1:1. The terms of instrument entitle HT Limited to proportionately more equity shares of RT Limited in case of stock split or bonus issue. So they are HT, one company is there, HT company is there, they are convertible preference shares of RT Limited conversion shares there. The terms of the instrument entitle HT Limited to proportionately more equity shares of RT Limited. Here the convertible preference shares will be classified as equity instruments in the books of issuer. Who is the issuer? RT. the variability in the conversion ratio only to protect the right of the holder convertible instrument by the other equity shareholders. So the conversion is always intended to be fixed ratio, and hence the holder is exposed to the change in equity value. So the variability is what is to maintain the holder's exposure in line with other holders. Next, after that, question number 20. So PG Limited company is there and BG Limited company is there. So here they have given convertible preference shares. On this convertible preference shares, what is the ratio? 10:1. So for 10 equity shares, each preference shares is L. So one preference share is L, they will get the 10 equity shares. For on fully diluted basis, PG Limited is entitled 30% stake in BG Limited. If subsequent to issuance of this convertible preference shares, PG Limited issues any equity instrument at price lower than 10 rupees per share, conversion ratio will be changed to compensate PG Limited for dilution in its stake below the expected dilution at the price of 10 rupees per share. So they provided convertible shares, but here amount was fixed. So when amount was fixed, it will become the financial liability in the books of issuer, and whereas BG Limited, that where the variability in the conversion ratio underwrite the return on preference shares and not just protect the rights of convertible holders, vice versa equity shareholders. Next, here one company is there, NG company is there, and they have AG company is there. They issued convertible preference shares 100 rupees per share, fully diluted basis. Now NG Limited entitled to 30% stake in AG Limited. So by purchasing that shares, if we converted the shares, it will become the 30% stake in AG Limited. Now the convertible preference shares will be classified as financial liability in the books of issuer, because AG Limited, the variability of conversion ratio underwrited the returns on preference shares to the extent and also restrict that return only. So only that to the extent of that they will get or they will receive, and the preference shareholders is not entitled to residual net assets of the issuer. So preference shareholders will get only to the extent of that portion only. They will not get right on that residual assets. Residual asset means remaining assets. In certain situations, an instrument is convertible only at the option of issuer, while such instruments provide the issuer with an unconditional right to avoid payment of cash. It is important to understand the economic substance of the option. It is also very important to determine whether the option is exercised by the issuer or by shareholders acting in their capacity as instrument holder. For example, if convertible instruments are is held by the equity holders of the issuer and conversion requires unanimous consent of all shareholders, so it would be inappropriate to consider that issuer has unconditional right to avoid payment of cash. Even though all shareholders approval is required, they do not decrease or they do not avoid the payment of cash. So here it is more relevant to consider right of the instrument holder. So for example, debenture holders is there, debenture bond is 8% bonds is there. For 8% bond, they need to pay the interest on regular basis, semi-annually or quarterly. They are right in AOA, that is Articles of Association. After the approval of equity shareholders, then we need to pay the liability. So up to equity shareholders is not approved, they do not have liability. No, it is wrong perception. Even though they write in AOA, it is not correct, because the application, whatever the obligation will be there to pay the liability, that is interest to the debenture holders, is liability only, even though equity shareholders are approved or not approved. Next, question number 22nd. So yes Limited is there, subscribe to convert preference shares of ATL Limited. The preference shares are convertible as follows. So convertible 1:1 if another strategic investor invest in the issuer within 1 year. Convertible 1.5:1 if prospectus filing is successfully completed within 2 years. Convertible 2:1 if binding agreement for sale of majority stake by equity holders is entered into within 3 years. Convertible 3:1 if none of these events occur in 3 years time. Examine whether the financial instrument is classified as equity. So Here we do not have any amount, means we will assume the fair value, so it will always become equity instrument. So here in the 4 events can be achieved as discrete, so because the achievement of each one of can occur independently, so it is independently, and the other as they relate to different pairs, the arrangement can therefore be considered to be economically equivalent to 4 separate contracts. The price per share and amount of shares to be issued is fixed in each of these discrete periods, with each event relating to different year and therefore separate risk. So the fixed to fixed test is met. Next, here they are given some amounts, so we need to consider because they are given amounts. So subscribe to convertible preference shares of RDT Limited. Preference shares are convertible as follows. So 1:1, another strategic investor invest at an EV USD 100, and convertible 1.5:1 if another strategic investor invested at EV USD. So they are linking. So if they invested 100, they will issue the invested 150, they will issue convert. Invested this one, invested convert in a period of within period of 3 years, 3:1. No strategic investment will be required. We need to meet this one after this one, then only they will get this one. If they here the 4 events are interdependent because second event cannot be met without meeting the first event. So if you are coming to 150 means the 100 is crossed. So if you are coming to 200 means 150 is crossed. So because of second event cannot be met without also meeting the first event, and third event cannot be met unless the first 2 are met. Therefore this contract should be treated as single instrument. So it will be treated as single instrument when applying the fixed for fixed test. The test is then failed because the number of shares to be exchanged for cash are variable. Now settlement options. So in settlement option, where derivative financial instrument give one party choice over how it is settled, it is financial assets or financial liability unless all settlement alternatives should be result in equity instruments. I think I will continue in next video.